Great. Hello, good afternoon, good evening, everyone. My name is Morgan Lamana. I'm Senior Manager of Investor Engagements at Ceres, and I lead the Climate Action 100 Plus North America Working Group. This is a member-hosted meeting alongside the Council of Institutional Investors virtual fall conference, and also, as many of you know, is Climate Week. For a full list of Ceres Climate Week events, see in the chat. Ceres is a nonprofit organization transforming the economy to build a just and sustainable future for people on the planet. And the Ceres Investor Network includes more than 200 institutional investors, managing more than 47 trillion in assets. We work with our members to advance sustainable investment practices, engage with corporate leaders, and advance for key policy and regulatory solutions. Just some housekeeping for today's session. You can ask questions using the question and answer or chat function. We'll try and direct questions to one of the speakers or get back to you afterwards. I really want to thank CalPERS and Westpath for helping to shape this conversation today. Next slide. So today's agenda, I will be going over some tools and benchmarks. I'll take you through three specifically: the Climate Action Net Zero Benchmark, Global Sector Strategies, and Responsible Policy Engagement. Really, we want to help orient investors and the wider market on the framework criteria, results of these assessments, and how you can use this data and research today. Next slide. I know we heard a lot for those of you who are at CII today about paper decarbonization and brown spinning, especially getting high carbon assets off the balance sheet. Or companies demerging their high carbon assets. Neither of those things will get us to a 1.5 degree trajectory, and it also doesn't reduce the risk of catastrophic climate change for investor portfolios. So the theme of today's session is shareholder engagement for sustainability in the real economy. The real economy concerns production, purchase, and flow of goods and services like oil, bread, and labor within an economy. So as we'll see from the Climate Action Benchmark data, over half of the focus companies have now set net zero targets, but I collected some headlines just from the last month of companies that are really now making changes in the real economy. Just a few examples. Phillips 66 has announced a $150 million investment in Tennessee-based graphite producer to fund the creation of a domestic US supply chain for lithium batteries. Maersk, the global shipping company that has one of the earlier companies on climate action to set a net zero target, has ordered 8 ocean-going container vessels capable of running on green carbon-neutral methanol. Toyota also just recently announced it will dedicate a production line in Kentucky for assembling integrated dual fuel cell modules designed for hydrogen-powered heavy-duty commercial trucks in 2023. So as we see, all of these things are new technologies, new investments, and affect the real economy. Next slide, please. So Climate Action 100 Plus, which is a partnership of 5 investor networks globally. Many of you have already be familiar with the focus list of 167 of the most carbon intensive companies globally. The Climate Action Net Zero Company Benchmark establishes a high ambition for companies across all sectors and regions in the world. While no focus company is yet delivering what is needed to stabilize the climate at relatively safe levels for all humanity. The Climate Action 100 Plus Benchmark and Climate Action 100 Plus investor signatories are deliberately and urgently moving the conversation from a focus on corporate emission target setting to an emphasis on companies' decarbonization strategies, low carbon business models, and related capital expenditures required to build the net zero company of the future. Public assessments for all climate action focused companies were published on the website in March of this year, and updated assessments will be available in March of 2022. Next slide, please. Just want to take you through as a review the 10 indicators of the Climate Action Net Zero Company Benchmark that were developed in consultation with investor signatories based on the 3 goals of climate action. So the first several indicators relate to action to reduce greenhouse gas emissions across the supply chain, as well as spell out a decarbonization strategy, capital stock alignment, additionally, governance of climate change, including board oversight, executive compensation, and management of climate policy and the just transition. And finally, disclosure in line with the TCFD. Next slide, please. So what you'll see here is the results, the aggregate results of all the climate action assessments. What we'll see from number 1 on the left. This is what I was referring to when I said half of all focus companies now have some kind of net zero ambition. The difference between the red and the yellow, no assessment criteria or partial, and the green, full assessment criteria met, reflects the need from the climate action framework for setting the target with all emissions, including scope 3 emissions. So 39 companies have met all those criteria and set targets in their full supply chain, whereas an additional 44 have just set operational targets. I won't go through all of these, but increasingly what we're seeing is companies are setting net zero by 2050 commitments. However, they may lack short and medium term greenhouse gas targets required to be on track. So that's where we see indicators 2, 3, and 4. Additionally, I'll just talk about the TCFD aligned disclosure. You'll see following investor engagement for several years, most companies have somehow signposted their climate risk disclosure in line with TCFD. But what we're really looking for to get in the green zone there is for companies to also do the full scenario analysis in line with the 1.5 degree scenario. And as you see, indicators 5 and 6, very few of the companies which comprise the highest carbon emitting corporations have defined the strategies, new business models, and capital investment plans needed to decarbonize their companies. Finally, don't expect you to be able to see all of this, but just want you to see what you'll be looking at. If you go to the Climate Action 100 Plus webpage to find the benchmark, you go to progress. There's individual company scorecards in the top right, and then you can see those indicators where they meet partial of the criteria. You can kind of unfold those to see the underlying criteria of what would get them a full green there. You can also download an Excel spreadsheet with ISINs for all the companies so that you can kind of look at yourself and do comparisons between companies within sectors and regions. Next slide, please. Let's see. So Climate Action 100 Plus has also developed the Global Sector Strategies Guides. The reason for this is investors engaging with some of the biggest oil companies in the world. The discussion moved to, well, what about the demand side? What about the demand side for energy? So these sectors we see, aviation, steel, utilities, food and beverage, are really going to be responsible for also developing technologies, working together on policy, and sectoral decarbonization strategies. So the goal of the sector strategies was to support investor engagement, understanding how companies can move through climate transition plans, and really identifying strategic priorities. The energy transition, will be different sector by sector for different companies. So as you can see in these guides, there's different kind of technological assumptions to discuss with companies that you're engaging. There will also be a necessary for cross-sectoral collaboration. One example could be, airlines working with refineries on sustainable aviation fuel. Next slide, please. I'll talk just briefly about another Ceres benchmark guide called Practicing Responsible Policy Engagement. The guide came out about 2 years ago, and now about 100, the S&P 100 have all been assessed. This is an especially important issue now as we're seeing climate policies, move through the U.S. federal government. So the Ceres blueprint on responsible policy engagement looks at, companies are assessing climate risks, advocating in favor of science-based climate policies and engaging their trade associations to support those. You can also go to the microsite digital tool. It'll feature recommendations, trend analysis, and leading practices, as well as the database of across 14 indicators that can be found in a number of formats as well. Next slide, please. Just a couple of key highlights. While large US companies are putting in place the right internal systems and processes to address climate risk, companies are providing minimal insight on how they consider climate change policy as part of the overall risk landscape. So we see that nearly all of the companies have set emissions reduction goals, and the majority are ensuring that this is a board priority. Yet only half of the companies describe the policies or legislation that will address climate change as a short-term financial risk. Next slide, please. A second finding that we saw the majority of large companies assessed have not translated their broader statements supporting climate policy into consistent advocacy in favor of specific climate policies. Next slide. Lastly, we found that 73% of the assessed companies are members of the United States Chamber of Commerce, and only a handful are pushing back against the Trade Association's longtime obstruction of climate policy. Next slide. So another question we get asked in Climate Action 100+ all the time is, when are you going to add more companies? We're looking for, investors, I think, are looking for a model of collaborative, data-driven engagements, with milestones over time to engage these focus companies. So Ceres has developed a multi-year campaign called Food Emissions 50, which engaged 50 highest emitting food companies in North America and asked them to disclose emissions, develop and disclose climate transition plans, and then implement those plans over time. We'll be following them over a few years. Next slide, please. So why 50 companies? Similarly, the methodology looks at companies that have carbon emissions embedded in their supply chains. Many of agricultural commodities fall under scope 3. And the global food system is responsible for approximately a third of all greenhouse gas emissions. So these cover mostly companies not on the climate action focus list. This is what the kind of a summary of the benchmark data. You can also go to the Ceres website and download a spreadsheet that details company by company so that you can compare. Next slide, please. And we'd invite any investors to sign on to this statement to begin with, really asking investors just to educate themselves, kind of look through the database, look through the questions, and then move on to engage and integrate the information into investment decisions. So it's a bit of a whirlwind tour. Next slide, please. So I think I've talked enough. It'd be great to hear some leading investors think. So we have Ann Simpson, Managing Investment Director, Board Governance and Sustainability at CalPERS. Ann is also the current chair of the Climate Action 100+ Steering Committee. Jake Barnett, Director, Sustainable Investment Services at Westpath Institutional Investments, and the Reverend Kirsten Snow Spalding, who leads the Ceres Investor Network and all investor initiatives. Will moderate today's discussion. So handing over to you, Rev.
Just delighted to be with you. Thank you so much, Morgan, for that overview. And really happy to have our two panelists today, or our discussion partners, Ann and Jake. Really lovely. So let's just kick it off. I'll ask a generic question to the two of you. Where are you seeing real progress? Where are you seeing decarbonization in the real economy? Some examples.
Ann, you want to start?
Well, maybe I can say the position that we have at on this question at the moment is we're coming to this very, very late. And the fear we have is too little, too late. So just looking at our own portfolio, we've identified these 100+ companies where we co-own with our fellow investors like Westpath and all the signatories that make up Climate Action 100+. That is going to be the target group for bringing down emissions. So one other data point to add to Morgan's really beautifully presented overview is the 100 companies just on scopes 1 and 2 are the third largest source of emissions on the planet. So number one, China. Number 2 is the United States. Number 3 is these 100 companies. And we've called them, these are the systemically important carbon emitters. So to me, the fact we've now got to a very healthy majority of these companies setting net zero targets, that's what we've been able to achieve, I think, in the first phase of Climate Action 100+. But look at the measure for aligning CapEx. That tells us what we still need to do. We are in the foothills of a very long, arduous climb. If we look in private markets, the situation for CalPERS looks a little different. We did our own TCFD report, wanting to lead by example here. We're talking to companies about them producing these reports. It was quite a big exercise because we have such a large portfolio. We're in many markets, different asset classes and so forth. But one of the things we were able to find is that in assessing our commitment to transition finance, if you like, we have now got close to 20% of our private assets in climate solutions. So that really shows the opportunity side, not just the risk mitigation, risk management. But to be honest, I think where we all are at the moment, the number that rings in my ears is COP26. If it was COP6, maybe 20 years ago, we would have been in a position to get a lot of this done. So the sense of urgency as we go into COP, and really at this stage, you know, our strategy, even though we're a very large asset owner, we're acknowledging that investors can do a good deal as the owners of the emissions, also as the allocators of capital into the opportunity, for sure. The other thing, though, is we have to be advocates for the public policy that's going to transform this situation that we're in, where it's been too little, too late, for too long. And that means issues like carbon pricing, removing fossil fuel subsidies, is essential. We need incentives lined up, not just internally at companies through their own incentive programs, but out there in the market. So that's number one. Number two, we've really got to get mandatory climate risk reporting. So you can either look at these results and say, as I am saying, too little, too late, or we can also say what's been missing in allowing the financial markets to really play their full role. So we simply don't have the reporting and the data. So we are, I think, Carbon Tracker produced a very nice report last week, Flying Blind. Flying Blind, perhaps this is more that we're in a situation where the data we have is more noise than signal, sort of to think about it in economic terms. So we do see progress in our own ability to allocate into climate solutions for sure, but we really have still got a very long way to go. So the winning votes we've had this proxy season are absolutely essential to progress, because that's us moving from saying we request to we require this progress, because as fiduciaries, we own this risk and it will fundamentally undermine our ability to carry out our fiduciary duty, which is ultimately for us at CalPERS, pay pensions for 2 million people and their families. So Jake, what's your take?
Jake, I just want to say, we touched on this in the plenary that I was on with CII earlier today, and Amy Boris asked me, she said, do you have any best practices, any good examples of companies that are doing it right? And I couldn't come up with one, but go ahead. We'll turn it to you. Maybe you've got some examples. And my answer was a little more nuanced. It was that if you look at the benchmark, we see different pieces where there really are leaders and laggards in each sector, but nobody's got it all right. But Jake, where are you seeing examples of good decarbonization plans and implementation?
Yeah, I mean, I would just say when it comes to good examples of plans and implementation, something that I really try to recognize and keep front of mind in the dialogues is that we're in a non-dualistic state right now, and that there's two truths that investors probably need to hold at the same time. The first is the urgency of what we're dealing with in terms of how much needs to happen, how quickly it needs to happen, how unprecedented the level of transformation is to really get to net zero. I work really closely with Patrick Pera from Allianz, and him and I co-lead the asset manager track for the UN Net Zero Asset Owner Alliance. And something that he said to me before, which I really appreciate, is we're basically trying to squeeze in fourth industrial revolution with the electrification of the economy in 30 years instead of 120. So this is really a very rapid scale and unprecedented transformation that we're talking about, needing companies to get started on today. The other side of the equation is just that it's rightful for companies to be a little overwhelmed about what's happening, and having them not have all of this figured out, having them not have all the greens is something that if I were in their shoes, I don't think I'd have all the greens within any of the sectors. And part of that is because of what Anne was referencing that I think is really important around the policy and economic incentives being aligned. Because if we were talking about achieving net zero, if I were to ask any of the investors and companies on the line, do you think companies have the ability to voluntarily say they're going to get to net zero with the current economic environment? For a lot of the companies that are in CA 100 plus that are those systematic strategic emitters, the answer is no. So what needs to change is the rules of the game that are defining the economic framework they are participating in. And I think a couple of things that are the best practices to your earlier question, Rev, around what does effective engagement look like. I'm really excited about the sectoral strategies that are coming out of CA 100 plus, because I think that brings us out of a piecemeal one by one approach to thinking more at a higher level. And then my hope is that investors get more sophisticated translating those sectoral observations to policy advocacy and dialogue. And then the last thing I'll say is a pet project of mine is certainly that I think asset owners need to get a lot louder with asset managers in terms of demanding bolder climate leadership within all of these different sectors of engagement that we've been referencing so far.
Mm-hmm. Yeah, maybe I could add something to that, Jake. You've just highlighted a really important aspect of this. The benchmark that we've developed, this 10-part benchmark to track progress, supported by these sector strategies. This is really important work. So the other thing that I think we need to look back on and mark as progress, signs of what's possible, is not just the size of Climate Action 100 plus, but I don't think we've ever had a collaborative engagement at this scale. The $55 trillion saying this is a sustained effort to identify, first of all, the systemically important emitters, as you say, Jake. Mm-hmm. We're not fooling around with, the marginal sectors where it's easy to make progress quickly. We're taking on the really tough stuff. So the size of the signatory base to me is definitely a real sign that investors are understanding climate change as not just a risk, but also an opportunity. So that's good. The second thing I would say in terms of investors really beginning what we need is investors to become the irresistible force. That's what we want the wider economic and policy agenda to facilitate. But if we look at the winning votes by investors this season, this is really moving us from that we request to we require the progress to be made. So we have to thank all the shareholders that supported taking some directors off the board of Exxon and bringing some new directors in with energy sector experience. That's hugely important. I would also, in the benchmark, highlight the fact that we have 8 companies which have started aligning CapEx, which is the toughest thing to do. And BP is an example here. They put 14,000 executives into a new bonus plan linked to their net zero commitment. They've also begun the alignment of CapEx, and they're at about the halfway mark. Now, for a great big oil company, that is not for the faint-hearted. It's big stuff. But I think as we look at the progress, my hope is, winning votes on so many issues and so many markets really shows that investors are willing to follow through. It's not just a talk endlessly. We now have a benchmark and there will be consequences. And I think the idea that stewardship requires that we cast our votes behind this sustainable generation of returns for our beneficiaries. That's the shift. So your point, Jake, is really important. I mean, at CalPERS, we're internally managed for public equity. It's about over 90%. But for those asset owners using external managers, I think there's a lot of good work that's been done around the idea of a model mandate. Who votes the shares? Who decides? Is there a default position to follow the proxy advisors? And that became quite an issue for some of us in the Exxon debate. We were very puzzled that, you know, ISS to its clients said, well, 3 of the 4 candidates for Exxon, terrific. They didn't support one of the candidates, but there was no explanation. Now that's a little troubling if investors are looking for, you know, analysis and insight. So I think all parties in the investment chain have got to get lined up. So we've really got an investor governance piece of work ahead of us, not just the corporate governance work, you know, that CII has led on so very well over the years. There's more to do.
So I want to ask kind of a trick question, and I know you can both handle it, but my question is, what's the role for investors in driving systemic change? And it's a trick question because when I put that question out to members of our network, a knee-jerk response is, it is not my job to change climate change. It's not my job. I'm not an environmentalist. I'm a fiduciary. It is not my job to work on climate change. But the two of you make this a big part of your job. So talk to us a little bit about what's the role of investors? How do you think about it? And you've named many of the component parts of your work on this, but Jake, do you want to start us off?
Yeah, no, I'd be happy to start off. You know, I think that there's a there's kind of layers to this question in terms of how you respond to it, because where the status quo of where investors are going to be most comfortable is in areas where there's well-worn, well-established, quantifiable grounding for fiduciary arguments. And that is something that should serve as a foundation of what we're talking about. And you can actually talk about this in the context of the work that SASB has done on dynamic materiality. You have that kind of core financial aspect of how we're thinking about systemic risk. And there are plenty of arguments to look at in terms of why climate change is material within that core financial piece. I think the thing that investors are increasingly needing to wrestle with and being challenged to step into is a recognition that their risk doesn't end at the bounds of what they can measure and at the bounds of what the status quo allows them to define as clearly fiduciary. And you see that in terms of a lot of the great work that's happening at different asset managers, at different asset owners, trying to think about what is the systemic risk to the portfolio and how do we engage in that systemic risk that goes beyond what we can quantify and what's well established on a backward looking basis. Now let's translate this to a real scenario. Let's talk about policy engagement. If you as an investor are saying, okay, so we understand that there's very real physical climate risk that's starting to manifest in our portfolio. It could disrupt our returns in the next 10 to 20 years that we're seeing, you know, clear pathways to rising sea levels, more extreme weather events, et cetera. We want to see policy. We understand there's transition risk and we think it's worth it, but we want to engage on that. The thing that I think investors need to keep in mind in stepping into that is absolutely do so. I think it's important to make your voice heard. Also understand that you are becoming one of many stakeholders beyond the financial community at that point. So I think that part of the question of what is the responsibility is just recognizing that your responsibility might be part of listening to what someone else is saying, following great work that's happening elsewhere, and it doesn't all need to be contained in your scope as a financial investor. You can rely on the expertise and the insights of others on these systemic issues, and in fact, you should. You know, Rev, I would say I'm consistently always impressed with the work that the policy team is doing, and I'm so happy they're there because I don't know enough about these issues as an investor to be intelligent. I need somebody else to get me smart on these things. So I think that switch where you're not trying to capture and understand all the data, but you're allowing yourself to kind of make the borders more porous and have yourself educated and informed by different perspectives beyond the financial community along the way.
And I was going to say, how do you define CalPERS' role in addressing the systemic risk of climate for your institution?
Yeah, thank you. Well, we set these issues out in our investment beliefs. We have 10 investment beliefs that we developed after the last but one financial crisis, which really took us straight back to the drawing board. Like, what do we think we're doing as investors? Can we just go about the traditional business of attempting to harvest risk premia in different asset classes and strategies to produce cash? We have to produce $25 billion a year in cash for current benefits we pay, and we've also got to manage close to $500 billion with growth in mind over the very long term. So for CalPERS, you have to realize that, you know, our liabilities run for the best part of a century. And also because of our size, we have nowhere to hide. So it's very evident to us that we rely upon, let's say, the global equity markets, where half of our fund is invested. We also have private equity, real assets and infrastructure, and of course, global fixed income. And we're building out private debt at the moment. My colleague Jean Zhu is leading that. The point here is that the system itself needs to be able to generate the returns upon which we rely. Just to put that into real terms for our 2 million members, every dollar that we pay out in benefits, over half, over 50 cents, comes from investment returns. So the system's ability, the broader economic system's ability to generate returns, and that has shifted dramatically. You know, some people, me included, are old enough to remember the days when you could have your fund in fixed income and handily earn 8%. That's a very different world from where we are now, where CalPERS has just shaved a little off our almost 7% discount rate because of recent strong returns. But the question of where you're going to find these returns puts financial stability at the heart of everything we do. So in these investment beliefs, where we went back to basics to say, you know, what are we doing here? We acknowledge that being long-term is both an advantage and a responsibility. In other words, because of our long-term horizon, there's certain things that we can do that might be more difficult for an investor with a short time horizon. It also gives us a responsibility to attend to the commons, the global commons that allows us to generate these returns. So, you know, in our strategic plan on sustainable investment, we identified data and corporate reporting. This is a system-wide failure. Market inefficiency is being impeded by the fact that we're not getting corporate reporting, which is consistent, reliable, integrated into the financials and so forth. So as Jake said, the work that the Value Reporting Foundation is doing is extremely important. Also, the work that is being planned by the IFRS, this is 140 countries accounting rules to bring standards forward, the work at the European Union, commissioning EFRAG, that body to develop. There is such an appetite for this data and information. Now, so that is an example of a systemic failure where we felt as investors, we had, as the audience, if you like, the prime users of accounts, we have a real role and responsibility for making sure that we're getting the information that we need and want. Now, there are other systemic risks which are also important to us. Think about cybersecurity. We also explored the whole topic of income inequality. This is a systemic issue that has economic impact. Now, the question of understanding a risk and then the question of how you respond are separate. So, for example, on the income inequality work that we did, we didn't see an immediate next step for us. There was company level engagement around living wage. We have supported proposals, for example, on other dimensions of inequality, like racial equity audits. We've called for gender balance and inclusion at company level. But I think working out whether something is a systemic issue, in which case you have to be advocating with policymakers, or if it's a corporate issue, in which case you can be engaging as a part owner of that company or that investment vehicle. So the danger, if you don't understand systemic risk, is you think of your role as an investor picking up pennies in front of a steamroller. Now, I've always loved that image. You know, oh, look at all these pennies on the ground. If you like, that's the risk premium. When you go off and pick up these pennies, this is marvelous. We'll put them in our pension fund. Terrific. If you're not paying attention to the steamroller, you've got two choices here. Either you get out of the way, you brush the pennies aside, or you go out and have a chat with the driver or put the brake on. So we're doing that. We are having a chat with the driver of the steamroller and pulling the brake, and in order that harvesting of returns can continue. So you can't avoid systemic risk. If no, it's certainly not for a big pension fund like that.
Yeah, I won't get that image out of my mind. I love that, Anne. Thank you. So talk a little bit about the leverage points that investors have. I think that our engagements with these companies in Climate Action 100 Plus have gotten stronger, that we're really seeing corporate responses. And then just maybe you can explore that a little bit. How did that come about? What are the points of leverage that you're using today? What do you see on the horizon as points of leverage in these engagements with companies?
Yeah, the vision, I think Morgan put it very well. The vision behind Climate Action 100 Plus was first to be data driven. We've identified those systemically important companies. Another metaphor from America, we're not trying to boil the ocean. We know that we have to be targeted and focused in order to get to the source of the issue. The other thing that's important is to realize our ability to be change agents within companies is quite, is bound, the boundaries to what we can do are set by local law and the governance arrangements in place. So what we've had to do in Climate Action 100 Plus is we've developed this model of lead investors where a local domestic investor will be often teamed up with an international investor. So we get that global coordination, but we're also able to really be deeply embedded in the local market situation. Now, think about Asia. 1/3 of the companies on that list are in Asia. We have an Asia advisory group, which really helps us think through market level strategy. The first that we developed was for Japan, with tremendous input and support from Hiro Mizuno, was then the head of GPIF. The GPIF has been it's a great example where your local major asset owner can guide the approach, because what works in America or what works in Sweden or London is not going to work in the same way in Japan, South Korea, or other countries. The next question for us to address in the region then was the question of state ownership. Like the idea of shareholder engagement in the Anglo-American markets particularly is this idea that, well, there's a dispersed share owner base. If there is a common view on a particular issue, then votes can be cast and change can be made. If there is a controlling shareholder in the company, you're going to have to work in a different way. So where there are state-owned enterprises, the counterpart in that conversation isn't just the other minority investors or minority shareholders, it's going to be the regulator. I think we should also be aware, even in the United States, a lot of governance reform had to take place to make it possible to have engagement. And I've told this story before, but I remember when, coming first to CalPERS and I heard about this majority voting agenda that was just being picked up through ICGN, the International Corporate Governance Network, was doing lots on this. But imagine you have an election and you say, here are the directors. Well, first we found most of them don't stand down. They take it in turns over a 3-year cycle. Then there might be one vote for 3 people. It's a problem. And furthermore, you can only vote yes. So I'm a little bit of proxy for it. So I can vote yes for some of the board members who are sharing one vote. You turn over the proxy. Where's the no vote? You can't vote no. So having to go, all thanks to the International Brotherhood of Carpenters, who filed the majority voting proposal at Exxon a few years ago. Many of us supported it. It missed by a whisker, but it was enough because we'd won at other big companies with big proxy battles, like at Apple, for example. It became understood that if you're going to have an election, being able to vote yes shouldn't be the only option on the ballot. If we hadn't done that, we wouldn't have been able to support Engine One, putting forward new candidates at Exxon. So understanding the complexity of the engagement arrangements in any particular market is extremely important. And that sort of think global, act local model for climate action 100 plus is very important. So, sometimes people say, well, why didn't you do this in this company in another market when you would have done it like that in the United States? And we've just been extremely careful not to think that we've got some, cookie cutter called engagement modeled. It could be modeled on any market you like. It could be the Japanese approach. It could be the French way of doing things. It could be the American. But the importance of having a global ambition and allowing that local progress to be designed, developed, and followed through at each market is extremely important. And I think it's part of the reason why Climate Action 100 Plus has a genuinely global signatory base. It's not just the usual suspects, to quote from Casablanca.
So Anne has touched on a couple of leverage points, certainly working on the boards, focusing on the governance structures. That's a core piece. Jake, I'm hearing from our members sort of a new emphasis on the auditors and on the financial accounts. Can you talk about that as a sort of new area where investors do have some leverage with companies? What are you looking for, and how's that working, particularly with these heavy emitters?
Yeah, so, you've seen a lot of great work coming out of Natasha Lindell-Mills at Ceres and Partners. And if an individual is looking to get up to speed on this, I would recommend looking at some of her op-eds and the like. But effectively, the conversation is moving to a level of assurance around what the statements are being made around climate and how those climate scenarios and different type of forward-looking plans that investors have long been asking for are then informing the actual 10Ks and audited financial accounts. And what you've seen as a result of some of these is that with some productive engagements that have happened in Europe along these lines with some of the European oil and gas majors, there were significant write-downs that occurred. Now, I don't want to conflate and say that that was all due to the engagement. Of course, this was in the midst of COVID, and there was other aspects of the commodity cycles that were being worked through. But certainly what you see is that there is a desire among investors to make sure that there aren't these disconnects happening. And there's multiple instances in which you can talk about these disconnects happening, but one of them is certainly is what you're saying in your CSR report, in your corporate social responsibility report, climate analysis, in your scenario analysis, translating to what your auditor is looking at in terms of the bottom line financials that you're expecting on some of your most important assets.
Yeah, maybe I could just add a quick point on that. We don't have to wait for new standards to come forward to start getting a better picture on climate risk. I mean, at the SEC since 2010, led by Ceres, other investors here, on this webinar were represented there too. The guidance that climate change is a risk that needs to be included in reporting, that argument was won. What didn't happen was any follow-up. And therefore, the issue of certain markets now mandating climate risk reporting, New Zealand, the UK, there are others, the European Union, sustainable finance work directive is bringing a huge amount of momentum. And of course, the IFRS with its international financial reporting standards. Now, what's interesting to me about both the SEC work and the IFRS is they are thinking about corporate reporting with a view of materiality, which is not just at the issuer level. And why does that matter? In other words, it matters to a portfolio investor like CalPERS small items can roll up to be a systemic risk. Greenhouse gas emissions are a perfect example. It'd be very hard to tick and tie a company level materiality assessment into individual emissions. However, when you get to our size and you've got thousands of companies, all of this is, global temperatures going up, that these emissions are contributing to that. What's important to remember is that in the United States, although the regulators have this concern, rightly so, and it is the approach SASB started with, is looking, and it's important, it's very important, but there's another level, and that is that materiality is in the eye of the beholder. And materiality for CalPERS may look different to materiality for a smaller investor or for a short-term investor. But the point of the Supreme Court judgment on materiality in the United States is what the information a reasonable investor would expect. And that is very close to the approach in the international scene. And I would I saw another question come in on this question of systemic risk and materiality. CalPERS supports the concept of double materiality. I know, as Jake said, this idea of dynamic materiality is important, but the idea here is we know because of our size, we know that ultimately risks which are impacting wider society will then affect the economy, and we will get affected as a universal asset owner. So the double materiality gives you a way of looking at what's coming down the line. So let's look at, say, planetary boundaries. Good place to start. There are 9 that were identified many years ago by scientists. We've blown through over half of those planetary boundaries. But paying attention to what's going on with those other planetary boundaries, has been traditionally thought of as being in the world of science, but we need that information in order to pull it into corporate reporting, and also to be able to roll up at portfolio level. So I think there's a huge opportunity now. I would say to everybody, read Nick Anderson's important paper that he wrote on climate risk and current IFRS reporting, international accounting and reporting. I think with this new work at the SEC, this new work at the IFRS internationally, the EU and elsewhere, what we're going to find is investors will be starting to look, the audit committee, what's been signed off in the corporate reports, and thinking about holding the audit committee accountable. In the same way that many of us moved into looking at the compensation committee, not just thinking say on pay will get you there, but holding board members accountable. The auditor, in many markets, investors have a vote to appoint the auditor. And exactly as Jake said, this question of consistency between the front end and the back end, or between the numbers and the narrative, are these accounts prepared with on the basis of sustainable assumptions, as David Pitt Watson puts it elegantly? These are going to mean, these are all going to be votes in the spotlight in the next round. And I think it will do nothing but good, because it will stiffen the spine of audit committees, and it was also will get the attention of the audit community, which is basically for global networks. So once that starts rolling, and there's a lot there through the international associations for accounting and audit, which are encouraging this, I think when it gets going, it's going to go quickly.
Yeah, thanks, Anne. And Anne is referring to a great question from Sarah Murphy. I want to just read it, and then Jake, I'll turn to you. Sarah asks, the speakers are absolutely correct to focus on systemic risk. That said, not a single proxy voting advisor uses a systems lens in their analysis and advice. They explicitly focus on enterprise risk to individual securities rather than the broader risk of corporate activity that externalizes costs to other companies in a diversified portfolio. IFRS has regrettably decided to take the same approach. Without systems level analysis and advice from proxy advisors, investors are hard pressed to take meaningful action in this regard. What are your thoughts? So Jake, specifically on that question of what are we going to do with the proxy advising services? How are you helping them or working with them to really think about these issues when they come up on the vote?
Yeah, so I imagine Sarah Murphy, with the great work that Shareholder Commons is doing, could come and give some great comments to this herself, and with the would point people to the universal ownership proxy tender as a way to learn about this. But I think one piece specifically that I know is taking place is having conversations with some of the proxy advisors around what would 1.5 degree aligned services look like. So if we're actually looking at net zero, they've developed out ESG friendly type services, but I think there is a real demand, and this is being articulated primarily by some of our European peers, around the need to have 1.5 degree net zero aligned voting recommendations, and that becoming a steady drumbeat narrative within the overall voting and proxy season. And you see that you see some of that infrastructure being developed by the benchmark itself. And I think, as Anne was alluding to, that will likely spread out to different aspects of board votes when it comes to audit. I wouldn't be surprised if increasingly, I think something that will start to come into the forefront is votes on those individuals that are in charge of public policy committees if there's poor alignment in terms of climate lobbying. Because there are resolution approaches to a lot of these different circumstances. Where, for example, there was the vote at Chevron last year or this past proxy season on the accounting net zero audit that almost passed. It was at 49%. Chevron is nonetheless publishing a report, so there was responsiveness to that. But the fact of the matter is that we can't wait for resolutions to be filed at all of these areas. And as Anne was saying, there isn't the governance mechanisms in a lot of these markets to have a resolution approach. So it needs to bake into how directors and governance are being looked at scale. And I think that so the proxy advice not only needs to start looking at this in a universal sense, it needs to start looking at it in terms of universal on issues and systemic basis. It needs to be applicable to different markets and the nuances of different markets and governance structures that Anne was speaking to earlier.
I just want to say I agree with every single word. And, we got a bit queasy about this idea of, say, on climate. We see the value, we can see where it would be valuable. But our concern is, hey, look at all the years we spent with, say, on pay. I don't think it's done that much. Pay and performance are still parting company in far too many places. So this question about board accountability is fundamental because boards have the potential here, tremendous potential, to help companies and therefore wider economy, wider society navigate this. But that means we need boards with three things. So independence, it's the traditional governance request. Secondly, diversity, because you don't understand new issues, things coming your way, the rapidly changing world without diversity. And thirdly, little appreciated, but so important, competence. So we need to start with what's the strategy of the company? How's that got to be evolved? How's it got to be developed? And then we must have climate competent boards. That was obviously the basic logic behind replacing directors at Exxon. But this question of ensuring that we have boards which are independent, diverse, and competent, which will vary by sector and perhaps stage of the company's development, that is going to be what will unlock further progress. So I would say making sure that the quality of the board is what it should be. That's what a lot of the great work CII has led over the years in the United States and other groups like ICGN internationally. But don't let's fool ourselves. If we don't get the governance right, nothing else can happen. So that can be patient, difficult work, but it's really important.
And I would just put one more nuance onto what Anne is saying, or just an additional aspect of it. It's not only the proxy advisor services. I think once again, this is an aspect where asset owners need to be engaging their managers, because ultimately a lot of those votes the levers are being pulled, so to speak, by large asset managers. And, I worked with Patrick from the Asset Owner Alliance to develop out a framework for engaging asset managers on proxy voting as asset owners. And I think you can both look at the proxy advisor as one lever, but then, you know, the ultimate votes are being cast by investors, and that ecosystem needs to be engaged directly too.
Mm-hmm. Yeah. Jake, I think there's a question from you that I want to ask before we close. I know we're going to stop at the top of the hour, but you asked, how do we collaborate with others to advance the goal of net zero by 2050? And I got to say, in my conversations with network members, they're saying now maybe it isn't even net zero by 2050, and 2050 is too far. We really have to be talking about a zero emissions economy on a very rapid time scale. So just a little bit about how each of you are thinking about your work with other investors to achieve that goal.
More often, lots of people smarter than me, so always looking to learn from them. But you know, I think when it comes to how we're looking to collaborate with other investors, it's seeking to, you know, come into the conversations with active questions. We have our own investment beliefs around low carbon transition, you know, the need to have a sustainable economy framework. And I would say, you know, the best way to think about engaging with other investors is just to identify the core questions that are really driving the answers you're seeking. You know, at Westpath, for us, it's engagement, it's thinking systemically, it's doing it collaboratively. And you know, there are more and more investors that share that viewpoint, and there's lots and lots of room to find collaborative common ground within that framework.
Yeah. And other ways that CalPERS is working with the investment community writ large on this problem.
No, we can't do anything on our own. I think, you know, we're humble enough to know that. Mm-hmm. You know, as the saying goes, if you want to go fast, go alone. If you want to go far, go together. Mm-hmm. And that's what we need to do, because we all have diversified our portfolios as one approach to risk management. But with a systemic risk, it doesn't help. You can't diversify a systemic risk. You have to tackle it. Now, there was another question in the chat saying, what do you do about an industry like tobacco? Well, we don't invest in tobacco. We think the risks there cannot be addressed through engagement. Likewise, thermal coal, likewise, assault weapons for personal use. Yes, there is such a category of product. So, you know, we're very thoughtful about where we think engagement can work, and also, is this an essential industry? Right now, the world economy is 80% dependent on fossil fuels for energy. I don't think, other than addiction, people feel that there is some social need being met through tobacco. You know, there are farmers and workers dependent on this industry, but that's a very different thing. So the question here then is, we need to be in partnership, not just with each other in the financial markets. That's very important. But we've also got to be in partnership with civil society. We've got to understand we are investing other people's money. In our case, 2 million families, money that belongs to firefighters and janitors and university professors and people working in healthcare and environmental sciences. I mean, we are fiduciaries for these people's savings. So this is something we forget. We tend to think of finance as something over here and the real world something over there. It's not. The money that we have in the financial system is the common wealth. It is the wealth that has been gathered together through the hard work and savings of the wider community. So we have a civil society partnership that's important to remember through our beneficiaries. And furthermore, we need to be in partnership with policymakers, government and regulators, because these issues will typically require movement on all three. Civil society will lead in democratically elected and even in some authoritarian government. Civil society will drive the policy agenda, as somebody was saying in the chat earlier. It's also going to set consumer demand. So it's not political expectations, it's consumption patterns that are going to be important. So this theme of partnership, we have said everything that we're doing on sustainability, partnership is an explicit part of the strategy. And long may that continue. You know, like how we enjoy very much working with Westpath and many things.
We are really so appreciative to both of you for your remarks, and I think that's the right way to end. It is in partnership that we're going to achieve the outcomes that are necessary, address the systemic risks in our portfolio, and really begin to move into the zero emissions economy of the future. So thank you both so much. Very glad to have had this conversation with you and all of our CII partners. We're looking forward to a good climate week as it concludes in the next couple of days. Take care.